Let's dig into part two now and continue this series. Okay, let's go over the comparisons of futures versus stocks, foreign exchange, small caps, and even penny stocks. We've already gone over how futures gives you the option to trade as many as 5,500 plus companies all in one index, like the New York Stock Exchange, the NASDAQ 100, S&P 500, etc. Okay, now let's compare this to foreign exchange. One of the biggest challenges is keeping up with global news. There's catalysts that can happen anytime, day or night, that can move this market one way or the other in large directions. And you don't want to get caught up in that, trying to keep up with global news and putting your finger on the pulse of all the currencies with all the countries involved. That's way more difficult. Okay, small caps and penny stocks can be great movers. You just want to make sure you find one out of the many thousands to pick from that has a great catalyst, has good momentum, moving upward with a lot of volume. That's a challenge within itself. Now, having that said, you don't want to be the first one in and the last one out. There's nothing worse than getting into a trade that volume comes in, that momentum goes up, then all of a sudden you try to take your profit as the volume dies down. As the trade starts to fall, you can't seem to get your order filled and you're caught holding the bag. There's a bad feeling that comes with that, and that the amount of profit that you had that you can't lock in. So that's a comparison to small caps and penny stocks. Okay, before we go into an overview of why to trade futures, let's talk about the pattern day trading rule. The pattern day trading rule is the minimum balance that's required in your stock trading account that's $25,000. Now think about this. If you have $25,000 in there and your first trade you lose $500, you've already fallen below the minimum balance. So you need above that 25,000 to give you a buffer. So one of the challenges there is you can't have more than 4 trades that are originated the same day and end the same day within a 5-day trading period. Those would be considered day trades. You open them one day, you close them the same day. If you have 4 or more within a 5-day trading period, you're considered a day trader. Then, if you didn't have $25,000 in your account at that point, your account gets flagged and you're considered a pattern day trader. Now, that is a challenge because you're always going to have to keep above that $25,000 balance to make sure that you don't get flagged. So, in an overview, you can see how volume, the difficulty of finding the exact stock, and the world news and foreign exchange are really difficult to keep up with. Now, the advantage to futures is you don't have that PDT rule that applies to the stock market. You never have to worry about volume or the difficulty of finding that exact stock. And all you have to do is watch the small amount of news that comes out on a regular basis and is kept up with to make sure that you're not in the market either 15 minutes before, sometimes minutes before, or minutes after. It's really simple, and I'll teach you and show you how to do that. The best part is all you have to do in futures is decide if you're going to go long or you're going to go short, meaning buy or sell. Each time it moves up, you make money. Each time it moves down, you make money. You're not looking for stock shares that you have to short. You're not looking for stock shares you need to go long. All of this is so much easier.